Have you been watching the rise of Bitcoin and other cryptocurrencies while feeling sidelined because of the technical aspect, not to mention the risk? You want to allocate some of your portfolio to this new asset class in order to get in on the gains, but worry about the learning curve involved in securing wallets and managing private keys? Headlines about scams, fraud, and wild price swings plague traditional financial news, so it's no wonder you think twice about investing. But at the same time, you might be one of the two-thirds of older workers facing a retirement shortfall. You work and save for years, but every time you get ahead, life has a way of throwing a financial wrench in the gears. Whether it's an unexpected home or car repair, a sudden layoff, or one of your kids that needs help, somehow you can never contribute as much to your retirement account as you need to. And the rising cost of living is not making things easier. What if I told you there was a way you could get exposure to Bitcoin without having to worry about the technical aspect of keeping your coins secure, without having to worry about scams or fraud, without having to open an account on a crypto exchange? And what if it would only cost you $100 or $2 a month? If this sounds too good to be true, I promise it isn't. And if you want to learn more about this method, then stick around, because by the end of this video, you will have a solid and surprisingly simple plan of action. So you have two problems with Bitcoin: the wild price swings and the technical learning curve. Let's address the solution for each of these. If you've been investing for a while, you're probably familiar with the concept of dollar cost averaging. In case you aren't, we'll break it down briefly. Suppose you have $1,200 you're ready to invest. If you were to invest the full amount today, you would be subject to the wild price swings you want to avoid. But if you were to spread out your investment over the course of a year, buying $100 worth every month, those wild price swings, or volatility, would be greatly reduced, with studies showing volatility of 9.2% for dollar cost averaging versus 15.9% for a lump sum investment. In addition to the lower volatility, dollar cost averaging offers the opportunity to buy a higher quantity when the market is down, lowering your average cost per unit and leading to a higher risk-adjusted return in the long run. So that's how we deal with the price swings. But what about dealing with wallets and private keys and the technical aspects of Bitcoin? Well, in case you didn't hear, in January 2024, the long-awaited Bitcoin ETF, which holds Bitcoin on behalf of investors, was launched by BlackRock, meaning you can now participate in the gains from the comfort of your 401k or other stock account. So, what's so special about dollar cost averaging into Bitcoin? Well, over the course of the last century, the S&P 500 index has averaged a 10% annual return, enough to double an investment in about 7 years. This is the magic of compounding, where the earning of a return on top of the previously earned return leads to exponential growth in the long run. So much so that Albert Einstein once called compounding the eighth wonder of the world. But let's compare that to this chart showing the lifespan of Bitcoin on a logarithmic scale. It has a cumulative annual growth rate of over 70%. And yes, this does take into consideration the years where Bitcoin delivered losses during cyclical bear markets. This means that if you can afford to invest $1,000 today and commit to buying $100 worth of Bitcoin monthly for the next 10 years, you would have over $850,000, in addition to whatever your other retirement savings deliver by that time. And if you can afford $100 bi-weekly, let's say with every paycheck, that number approaches over $1.5 million. Now I want to take a minute to talk about the long-term potential for Bitcoin. If you've been involved in the financial markets in the last 10 years, you might have heard the phrase, bad news is good news. While counterintuitive, it refers to the phenomenon we've been seeing on the markets, where the announcement of negative economic numbers has resulted in a rally in the stock market. The reasoning here is that if economic conditions worsen enough, the central bank, the Federal Reserve, will be more likely to ease monetary conditions, i.e. lower interest rates and engage in digital money printing, aka QE, which will ultimately stimulate the economy. What then happens is that such a large proportion of market participants try to be the first to buy the dip, that the dip never actually occurs. The logic here applies doubly to Bitcoin for one reason: inflation. The federal government is over $30 trillion in debt, with $11 trillion of that to be refinanced before April 2026. Interest expense is already costing the government more than the defense budget, and if this $11 trillion is refinanced at the current comparatively high interest rates, it'll quickly become their biggest expense. This is not good for their credit rating, nor for their position as the global reserve currency and issuer of the only risk-free asset. The Fed is also committed to ending quantitative tightening. In response to the economic impact of the events of 2020, the Federal Reserve started a stimulus program called quantitative easing that involves creating additional digital currency units, aka printing, to buy long-term government bonds in the 10 to 30-year range. This is called quantitative easing. This has the effect of lowering long-term interest rates while increasing bank reserves, making banks more willing to lend to businesses and consumers. The problem with this is the huge amount of inflation it caused, as you're probably already aware. So to combat this inflation, the Fed started a process called quantitative tightening, the opposite of QE, that involves them reducing the amount of government bonds on their balance sheet. Jerome Powell recently confirmed that their QT program would be ending December 1st of this year. This has led many to speculate that the Fed will likely start QE again to support interest rate reduction. It is important to understand that the Fed only has direct control over short-term interest rates, the discount rate, and the interest on reserve balances held at the Fed. The way they manage longer-term rates is by open market operations and quantitative easing, where they create additional currency units to buy government bonds. Since bond price and interest rate are inversely related, these massive purchases by the Fed have the effect of pushing up the price of the bond while at the same time pushing down the rate that it pays. So the Fed has lowered rates, they've stopped reducing the money supply with QE, and they're likely to start expanding the money supply again in the near future with more QE. What does this mean? More inflation. Bitcoin was created in 2009 in the aftermath of the Fed's response to the Great Financial Crisis. Its creators precisely designed it to be an inflation hedge and a new capital base for the 21st century monetary system. Bitcoin's algorithmic scarcity makes it impossible to print. The only way more are created is through a process called mining that involves devoting massive computational resources to processing transactions and securing the network. This starts to get technical and could easily take an entire video series to explain adequately. Suffice it to say that its performance, especially within the last 5 years, should be proof enough of its ability to hedge against the devaluation of the currency. So to recap, despite what you may have heard, it is not too late to get into Bitcoin. If you want to get in on the gains and protect your nest egg from runaway money printing and unpredictable government policy, the easiest and least risky way to do this is to dollar cost average into a Bitcoin ETF like BlackRock's IBIT. We will probably see some volatility over time, like we're seeing now, but in the long run, we're dollar cost averaging into an asset with a 70+% cumulative annual growth rate. And if we stay calm and stay the course, we're looking at a portfolio value approaching $1 million or more, depending how much we're able to contribute. All this while the Fed is cutting interest rates, has announced a plan to stop the money supply reduction, and will in all likelihood fire up the money printers again next year. So always remember, DCA is the way. There are a host of other tailwinds supporting Bitcoin's price in the long term, which I did not have the chance to get into here, but I've covered a few of them in the past here on this channel, if you want to take a look at some previous videos. And I will continue to keep you updated and bring you more analysis as events unfold. So please subscribe if you want to hear more. So if you made it this far, thanks so much for watching. Please like and subscribe for more content like this. And thanks for your time.